And we're back, and we got Kevin Green back today. Kevin, how was your vacation, man? Let the audience know we're talking about you, hoping it was going well. How was your week off, man?
It was good. I mean, obviously it goes by way too fast. And I went to Chicago, so I'm originally from Chicago, right outside of Chicago. So as soon as we touched down, it was like, hey, at my parents' house for like a day, drive 3 hours to go to Springfield, hang out there for like a day, drive 3 hours back. Mind you, our flight's only like 2 hours to get there. So we spent more time traveling than actually hanging out. But it was actually a good time, and then ended up scooping up a new puppy over the weekend. So that's also exciting. So overall, it was actually a really good vacation. Wish I had more time off, honestly. And if you can tell by my voice, maybe getting a little bit under the weather. I think we got something kind of going around, but I appreciate you guys kind of holding down the fort while I was out. And it was actually kind of an interesting week last week too, right? I mean, we were looking at the commodity space as a whole. I think some of the technical indicators that we've been focusing on, especially I know we'll talk about gold later. The pullback that we had, it seems like a little bit more of a consolidation, and then also having that consolidation with crude. So kind of a light week when you're looking at it, but a lot on the radar when it comes to the commodity space in general.
Yeah, the commodity space is always interesting, and especially the last couple weeks. It continues to really hold up better than expected. And once again, even looking at like commodities and inflation rates and inflation numbers, like we're still seeing an uptick in these. I actually got a inflation signal for our regime model like a week ago. So basically, fundamentally, we're kind of heading into more of an inflationary regime. It's really interesting, something to continue to watch. And really, for me to really get bullish on that, I'm going to have to see oil actually start to move. So, to get it back to you, Kevin. So, you brought some charts on oil. I will bring
Yeah.
those up in a sec, but let's talk about oil. Let's talk about gasoline. People want to know what should they be doing with their energy trades, and they want to hear it from Kevin.
I don't know what you should do with your energy trades, but here's the
Not
thing.
financial advice.
And not financial advice by any stretch. And I'll actually have to send you another chart. So a couple of different dynamics are actually taking place right now that I think is very interesting as we kind of start off, round out this year, and then obviously starting off the new year, right? So if you're kind of looking at U.S. gasoline demand, for the most part, it's matching what we saw for last year. The trend is pretty much intact. And even if you're looking at the 4-year moving average, basically looking at the time series of events around this time, we're averaging out kind of the same. Now, there's always this battle between energy traders over the next couple of weeks where you see TSA travel demand data that goes out there, how many people go through the airports. You're going to look at flight tracking, but then you're going to see on the other side of that maybe jet fuel consumption it has not been as great. And that's actually the truth, right? You could say that maybe there's a little bit more efficiencies that are going there. The type of travel has changed as well. More international travel, domestic travel in some respects has kind of softened a little bit. And you could kind of get that by some of these companies that are reporting. Now, the jets in general, if you're looking at the ETF, has done a phenomenal job. I think it might be a little bit overdone, but there's some positive pricing pressures that might be impacted, or basically margin pressure advances that they could actually have, which I think that's where the optimism is coming from. But the interesting dynamic is that the gasoline demand domestically, for the most part, is holding up. And if you look at gasoline inventories, and I'll have to actually get you this chart. So I'm going to talk about it right now. Maybe we can bring it up here a little bit later. But if you're looking at gasoline inventories, we're actually at the lowest level that we've seen for inventory levels in the last 5 years. We broke out of this like range, if you will, and that's being reported by the EIA. And that's actually a pretty decent setup going into next year. Now, you kind of just talked about your inflation, signal that you might have picked up. This could be another one of those signals. We're not 100% there yet, mind you, but you're starting to get some seeds being put into the ground, if you will, that you could actually have a fairly dynamic spring when it comes to energy products. And I would say, over the next couple of months or so, heating oil, which has been a laggard and something that actually has surprised me throughout this year. I thought that we would see industrial transportation, especially when you're looking at ground freight, actually rebound very in a healthy manner, and it just has not. It's still in a recession. But you're also seeing, heating oil inventories, which also includes diesel, right? We're kind of use those interchangeably. Those are starting to, for the most part, normalize out. And then there's a seasonality factor where diesel and heating oil is still actually utilized in the Northeast for heating boilers and things of that nature. Now, over time, that's going to change, and there's going to be more being tied into the natural gas side. But there's still that element there. So if I actually do rank them over the next couple of months, what I'm really looking at is heating oil for the next 60 days or so, kind of being your first gauge of interest if you are going to see this type of reflation trade take place. The next one is going to be gasoline, just because of the structural nature of the product itself, right? Low inventory levels. We're at about a 90% utilization rate right now when it comes to refiners, which is actually relatively high. So we had like a brief start of the maintenance season, then that kind of like backed off. And then the first 2 weeks of January is usually where we see a massive, and when I say a massive decline in utilization rates, going down to around 84.5%, 83%. Why do I bring that up? Utilization rates, for the most part, kind of it judges your throughput for a refiner, right? The more that you're utilizing at a refinery, theoretically, the more output you can have, right? And then the lower utilization rates kind of tightens up supplies as well. And so if we have that seasonal period of refiners going offline, you're going to have a maintenance season. Let's say that we do have an issue, which I would suspect that we will have an Arctic blast between now and March of this year, or of next year. We will have an Arctic blast that's going to impact the Bakken region up in North Dakota and things of that nature. If that is going to be the case, given the inventory levels for gasoline, I think that really does give you that structural sense that maybe we do see a pop. Cherry on top of that is going to be Chinese, economic data. We had some PMI data that came out overnight. Manufacturing side was actually better than expected, but when you look at services, it actually faltered. But we really kind of care about the manufacturing aspect of their economy there. So what does this all mean? Let me put this all together here. Gasoline inventory is low. Any type of spark in demand or outlier in demand from a seasonal standpoint will put positive pricing pressures there. You have the OPEC overhang that we have to just be mindful of. We have the meeting on Thursday or Friday. That's the 5th. I think it's on Thursday. We'll see if they're going to give us any type of guidance as to supply expansion for next year. You have Russia that actually just removed its temporary halt of gasoline exports to major producers. That's sounds scarier than what it is. They've been off and on with that, so it just kind of depends. Like once they get two refiners like hit from Ukraine, like they kind of like back that off, and I won't even go on that tangent of what the hell is happening with Russia right now. Russia is not looking too great just in general, but the chart for a lot of these energy products still says not that great. You could also make the case though that we might be in a compression stage, basing out stage. You get some positive data, you can kind of pop to the upside. And if we do have that over the next 60 days, what I'm looking at from a technical standpoint is for us to be able to pretty much touch the anchored VWAP that we have for the highs of this year. That's sitting at around $75.42. If you're looking at year-to-date anchored VWAP, that's sitting at around $76.12. I'm always a little bit more conservative, so I would say a bounce up to 75.42 probably would be your fade type of moment here, and you could probably still scalp the $67.5 level, scalp that for $1 to the upside, maybe $2 to get to 70. Really kind of wait to really try to spike this thing out. So that's where I'm at. It's been a very hard trade. The monthly chart does not look great. I'll go on the other side. Let me balance this out. Monthly chart on crude oil looks like we're going to fade down to $40 to $45. That's a monthly chart. So monthly charts are going to take a very long time to develop. I wouldn't say that's going to happen next week or the week after next or whatever. But it doesn't look good on a longer term time frame. But I think in the intermediate term, we might see a potential pop here as we have this consolidation. We've been able to manage these lows sitting at around once again, $76, $76.50 there.
And Kevin, I wanted to get your thoughts on transports. Like the Dow Jones Transportation Average has gone nowhere for years, and it's just now resolving this base to the upside. Like if you go and listen to these conference calls, like a lot of these companies have been saying they've seen some rolling recessions and stuff like that. So like not only is it bullish for the economy, but is there something there with heating oil too?
Yeah, so and everybody's going to have like their own take on this. I actually do believe that a lot of the equity advances that we've seen over the last since the election here has been more of a FOMO trade rather than an all clear type of signal trade. And when you're looking at the industrials, it also depends on which industrials that you're looking at, right? Especially when you're talking about the transports. Because if you look at rail, rail for the most part has been able to hold up. You have Union Pacific looking all right, pretty much in a pretty consolidated range, right? You have also CSX for the most part in the consolidated range. Rail has already kind of felt the impacts, but they've had the benefit of pricing power on the fuel surcharge side. So for like people, rail companies make money several different ways, but the main way that they make money is obviously transporting goods, and the main profitable goods, if you will, is going to be coal. You also have autos, right? So that's going to be like the CSX side, anything that's on the East Coast. So CSX manage like the East Coast side of the equation. Union Pacific more Midwest, and then going out to the West there. Grains, which hasn't been as profitable, and then fertilizer. So those are, if you look at one of these earnings announcements for locomotive companies, if you will, right, the Union Pacifics of the world, that's going to be the area. So coal prices have been god awful, but we did see a little bit of a spike once LNG got a little bit more expensive. We did see like China importing more coal, but prices for coal for the most part has been god awful on the spot basis, right? So they've had lackluster margins. We already know what's happening with the grains, right? I mean, at the end of the day, we are seeing a little bit of a pickup when it comes to grain export orders over the last month and a half, and we've been talking about that. But it hasn't been anything that's been like spectacular, but they make money on the grains. Fertilizer, that's going to be more of a Canada-US item, and that could actually be in the crosshairs in the next 60 to 90 days. So let's see what that's going to be able to do. But the key area that they have been able to leverage pretty much post-COVID is this fuel surcharge. So these locomotives, most of them use heating oil or use diesel. Okay, so they would see positive pricing pressures to the upside. These rail companies will say, okay, cool, 15% markup, 20% markup, and we're going to pass that straight to our customer. If diesel's going for $2 a gallon, this is an example, we're going to charge $2.15, $2.30, and they call it a surcharge, but it's not like a net neutral just to cover costs. They've actually found out that they can actually charge a whole boatload for this surcharge, and that's actually been the icing on the cake for the top line. So I think you're also kind of getting some of that optimism that is there. But if you go to other companies like JB Hunt, JBHT is the ticker, hasn't been great, maybe some positive signs, but we don't really know yet because they did see a positive, impact to their business, their intermodal business towards the latter half of this current quarter. But we don't really know if that was getting ahead of the port strike or if that's actually true organic growth. Okay. Here's the reason why you asked that question. Target, that stock fell off the map, which I would say kind of maybe a value area right now, but fell off the map, and it told you exactly what happened. Look, we ordered too much because we wanted to get ahead of this stuff, right? So JBHT, not really too hot either, but transports, I think they're just catching a bid because these value plays, or you're looking at companies that just have not participated. Usually towards the end of the year, especially for a Santa Claus rally, is when you get a lot of these companies to participate. It would not be outside of the realm of possibility that Target catches actually a pretty decent bid over the next couple of weeks. I would say the same thing for Boeing. People have been crapping on Boeing here, but one thing that I actually talked about 2 weeks ago was actually looking at, and I'm kind of going through these, but this is just another example. This might not seem like much when you're looking at the chart, right? Yeah, on a 1 year basis, or even looking at the 3 year weekly chart, Boeing was trading at $280. But 2 weeks ago, Boeing was trading at $140, and no one wanted to touch that company, right? But at the end of the day, when you're kind of looking at the valuations, this is a bottom feeder. What's the worst thing that's going to happen? You're going to continue to break those lows and continue to go lower. At some point, the asset values that they actually have for the company makes it attractive for that longer term investor. And that's why I think you're seeing that bid stepping in. Also, the other reason why I bring this up, 140 strike calls going out for 2027, 2 years out. Let me get that for you, because what was actually very interesting, the I'm sorry, the December 2026s 2 weeks ago were going for like $28. The options, the calls, $30. They had a fill at 30. So you're seeing it where it's like, man, you could take a shot here. And even if you go on the leap side, there's some alpha. So I think you're finding a lot of these companies getting positive flows because of these same type of chart setups. Dollar Tree is another one. I mean, I'm going down the list. Dollar Tree could be another one that's on that type of list. Hasn't gotten any love. They got earnings this week, so be careful. But even if they report in line, I'm pretty sure that stock's probably going to rip to the upside. So going back to the transports, and I'm sorry once again, but going back to the transports, I think that the majority of them catching a bid is not so much the story of expansion. I think it's the story of maintaining and being in oversold territories, or just hasn't, on a relative basis. You guys do ratio charts literally all the time. On a relative basis, they weren't performing, right? And so I think you're now seeing maybe a little bit of a rotation going into those stocks there.
No, I like this, and it's a good conversation because, and you're right. When we get that, we call it small cap season, and any seasonality trader will tell you that small cap season, meaning that you see a lot of these sectors that are industrial, small caps, transports. These start to move towards year end. You start to see outperformance in these areas, so it's a good time to kind of look over some of these stocks. I like that idea right here. So Sam, you brought this chart of gold. And so I want to pitch this to you for a second. What do you think about gold? I know everybody wants to know what's going on with gold. Should we be buying more gold? What's going on with the dollar? I also have that dollar chart here if you want to go to it too. So let's start with your gold and the sentiment indicator, which I really like that you built this.
Yeah, for sure. So gold broke out earlier this year in March, and during that time, Bitcoin made zero progress. And gold went on to hit 2 of its Fibonacci extension levels. And now you're seeing Bitcoin break out, and you're seeing rotation into more speculative areas. So gold's kind of taking a breather, but I really do not think it's over. I think it's just getting started. I think right here, right now, is a very interesting place to accumulate gold. And if you're wanting to do that, who better to buy with than the commercials? And the COT sentiment indicator shows when the commercials are outpacing the speculators in their buying activities. And right now, that's what you're seeing. So if you go back and study history, like all of these dips, you've seen commercials buying aggressively, and you're seeing it again right here today. So I don't know what the value of gold is, but I think these commercial hedgers have a much better grasp on what the value of gold is. So I love following them and accumulating here.
Yeah, and if you talk to anybody in the industry, it's kind of interesting. They still, they see more upside potential in gold. Now, once again, it's hard to also talk to people in the industry because obviously they're going to be bullish on the product that they're getting out of the ground. But at the same time, is they have the data to back it up. What does it look like? What's the supply and demand numbers? All these things. Now, gold is not exactly a supply and demand market because there's so much supply. It's really a psychological market. But we are still seeing that psychological rush into gold on these dips. And I would be more concerned if we saw this dip and nobody bought it up. That would have been more concerning to me. But the fact that they're buying it up, we could possibly move higher in gold. I think it's a good time to buy this dip. And also another thing is the dollar index.
Yeah, you've got to mention this if you're talking about precious metals.
Yes, if we're talking about precious metals, and we got to talk about the dollar index. And so if we look at this dollar index and that reversal, like once again, it's you go back in time, and I don't always bring all this up, but let's go a little bit through history. We'll go to Victor Sprandio. Victor Sprandio was one of the first people I ever saw talking about this pattern. If you study market history, that's basically when you see a breakout and a reversal. Trader Vic called it the 2B pattern. And so you see a breakout and a reversal. What I found in back testing it is it's not very significant unless it's over a long time frame, over at least 100 days. This is over 100 days. So this is a significant one Not to mention, it bumped a 52-week high and reversed. What else did we see do that recently? Bonds. Bonds hit a 52-week high and also reversed. So once again, I do think that this is a pretty good time to go, okay, I have a tight risk. I can buy a dip with very tight risk. I can try to trade it higher. It makes it a very simple trade for me to at least take advantage of, because all you want to do as a trader is get good risk to reward. You can't get everything right, but if you have good risk to reward, you can put in a close stop, understanding that if the dollar starts to break above 108, 109, you want to be out of it, out of your long gold position, or if you're shorting dollars, out of a short dollar position. And that's as simple as it gets. It doesn't get much simpler for traders than that. So, Kevin, I wanted to bring up one more thing with you that was kind of interesting. Something I saw you retweet and laugh about, and I was kind of giggling about this one as well. So I'd like to hear your opinion on this one. So Trump threatens 100% tariffs on BRICS countries if they undercut the US dollar. So let's talk about this one. I have so many views on this tariffs situation, and people, I understand it like sounds nice in theory. You know, you bring back jobs to the United States and everybody's prosperous and all these things. It's just not how the world works. And tariffs are usually pretty destructive for each country. It's the reason why free trade works. Free trade is one of those things that really helps to boost all economies involved. So, Kevin, what are you thinking about this 100% tariff idea? I'm not trying to get political either. Like, I don't really care. Like, for you guys who follow me for a while, you know that I actually don't have a opinion on this, and I don't have a guy in the race. I'm just sitting here looking at it and going, this is how the market will react to these things. So, what are you thinking about the tariff here, Kevin? 100%. You think that's possible?
No, no, not at all. So what I find what is going to be very interesting here is like comments like this, the market's not even taking it serious.
Yeah.
At the end of the day, and once again, I'm not going to get political with this, but I feel like the power of the presidency, we got to be mindful of the words that we say because they should carry weight and stuff like this. I don't. At some point, it's kind of like the little boy cried wolf situation, and that's kind of where I'm at with it. Look, especially when you're looking at your trade partners. I mean, our number one trade partner right now is Mexico. You can be really mad about what's happening with the border and all of that, but I mean, Mexico has been a phenomenal trade partner. They continue to expand, and what's also very interesting is that it's not just like they send us one trinket or two trinkets, right? Like they actually export a fair amount of good services as well. Very educated population. They continue to grow and expand. So you kind of don't want to really do that. And this goes separate from BRICS, right? But I got to bring it kind of back home here real quick because the commentary around tariffs on Canada is also a very big thing. I mean, the big part of our trade partners is the alliances that we have with them, right? And so you don't want to isolate everybody. And I feel like that's the commentary that we're getting right now. If you're a BRICS country, we're going to potentially isolate you. China, we're going to isolate you. Mexico, we're going to isolate you. Canada, we're going to isolate. And at some point, they're going to be like, yo, okay, like we can do without. And I don't think people really understand the dynamic of that. People are looking at it like, yeah, you're going to bring some jobs back to the United States. That's not 100% given. You can actually see EU policy in certain respects is actually failing on that and on those fronts, right? And we actually have a really good blueprint from some of these European countries, and even if you're looking at the UK. 100% tariffs on BRICS countries, I don't think is going to be something that's possible. And I think it would actually have, and I'm not even trying to be dramatic, I honestly do think that it would be something that actually accelerates these BRICS countries from on trying to complete this de-dollarization.
I do too. That's the biggest point. I completely agree with that. And it would just push them over the edge. And I'm seeing, these replies from Russia and these other countries at the moment. They're not pretty. So I do see this situation, and people don't understand. Like, people think about it like good for the country or bad for the country. It's like, yes, like there are, you could say like there's an interesting story Murray Rothbard wrote about years ago, which is on free trade, which is go to Michigan. There was a time in Michigan in a specific area where they wouldn't trade with anybody, and they tried to do everything in-house in one small part of Michigan, and a bunch of people died. And you basically turn that into the Soviet Union, you turn that into Cuba. Like, these things are not perfect. They don't, it doesn't turn into, okay, now there's a bunch of jobs in the United States and everybody's prosperous. It can turn ugly pretty quickly. And not to mention, what if our trade partners just do what Kevin says and they go, okay, we're going off the dollar, screw this, we'll do without. Like, that is a very bad situation.
And it's not going to happen overnight. I think that's also, it's not going to happen overnight. The key portion of this, and I'm sorry, but I want to make sure I get this out because it's very key. You're not going to see a complete drop off of dollars being used to transact, but the lack of purchasing of U.S. Treasury is going to be your first signal. And that's where you have a problem, right? Once you start seeing a little bit of a fall off when it comes to Treasury purchases, that's when you're going to be like, okay, now the debt that we issue, obviously we already know about the debt burden, talk about that, but that's also going to have an impact when it comes to the strength of the dollar. You could have a situation too where the dollar actually, once again, utilization rates kind of go down a little bit and the dollar actually weakens. And then the purchasing power for consumers actually then goes down, which is also inflationary. And last thing I will say is there's only two things that create value for any country that is out there, right? Actually three. The education level of the citizens within that country, the labor or workforce within that company, that country, and its ability to pay off debt service, right? That's what makes us great, is that we can continue to issue debt even as consumers and continue to consume. And then it's military power. That's it. There's nothing more. You could bring up 80,000 different charts of metrics. It's all about power that you got, kinetic power, right? Or consumption power. And if you're going to piss off the people that are giving you the consumption, they're giving you the goods, especially our two biggest allies, it's not going to be really good for when it comes to the consumer. If you also, and this is not like he's a war hawk thing, but it is, like, you pull back militarily, you also then weaken the defenses of some of our allies. Some of our allies are the biggest purchasers of US debt. There is a reason for that. It's not just like, oh, America is just great and it's the symbolism of freedom and all that. No, it's not, right? They're buying our stuff because they like what we do. And then they also feel like they have a cover, right? It's a nuclear umbrella that comes with this stuff. And so if you want to continue to pull back and people are pissed off, I got to go down this route. And you're pissed off about what's happening to Russia, Ukraine, and all that shit. And like, oh my God, we're spending so much money. Why don't you worry about what's happening here at home? There's a reason why we need to be there and cannot give up power there. There's a reason why. We back off, Poland could be at risk. If Poland doesn't feel like we got their backs, are they going to be doing business with us? Probably not. If the UK feels like we don't have their backs, are they going to still do business with us? Probably not. Because at the end of the day, that's what they're buying. It's a quid pro quo. Let's call a spade here. So I feel like that's the risk that we are at right now. If we pull back militarily and lower our or consolidate our footprint, doesn't give us that much leverage, right? And if you alienate every single country out there and you say, hey, you want to do business with the US, you're going to have to pay up or flight. Dude, enough people are going to be like, yo, okay, I'm done with this. For what? What are you guys going to be providing? And I'm not trying to nation bash here. I love this country. But at the end of the day, what leverage do we have? Everything that we consume is debt. Is debt financed. Consumer, or even you look at the government. Let's look at it from the consumer. What's going to happen? You're gonna raise prices on people and not protect them. They're gonna say, "Hey, go jump in a lake," because that's how like extortion really works, right? You got to have certain leverage over somebody to be able to get them to do what you want them to do. Once again, I'm just being real. So if we're gonna pull both those levers back and tell everybody to go F themselves, I don't see like how this is actually a really good policy. And it's not just what this new administration is doing. That's the same commentary for the previous administration and Biden, right? At the end of the day, this tit for tat with China has kind of gone a little bit too far. We're both pseudo self-destructing from a consumer standpoint, especially when you look at the middle class, because they want to go tit for tat. So it's like, resolve the issue, dude, because China can be great and we can be great. We just stay in our own lanes and we'll be good. And that's just a situation that's not happening. And we continue to see this like domino effect to it. So the tariff thing, I don't think it's going to happen. And if it does happen, I do believe that you're going to see major backlashes. And I think that's going to be a problem. I got to say one last thing. A really good example of this, and I'll kick it back, I'm so sorry, but the really good example of this is France. Okay, so if you guys look at history, I'm a student of history, and I think it's very, very important to see what has happened in the past. Usually kind of rhymes, right? It's not a one-for-one thing, but it does rhyme out there. France is having the same problem right now within Africa, right? Especially when you're looking at Southern Africa. You're looking at Niger, you're looking at some of these other countries that are like, they got military presence there, they have military bases there. You know, you could call it imperialism all you want, but that's here nor there. But they had a presence there. The reason why they had that presence is because they were providing the protection, quote unquote, and they were also getting access to the resources. Now, Russia is now the big influencer when it comes to Africa, and they're kicking France out. And France has got a problem. They're going to have a natural resources problem that's going to reverberate throughout the whole world. And we're seeing it when it comes to uranium supplies right now. If Russia cuts us off, which it looks like they are, we're going to have a big problem when it comes to uranium. So yeah, that's just a good example of like, you got to kind of back up what you're doing. And you people may not like war and people may not like military, but that's how the world works. That's how humans work, right? So that's my thing. It's hard to pull off 100% tariff policy when you don't have any other leverage outside of the U.S. consumer, which is all debt financed by those same individuals that you're pissing off.
Kevin, I agree with everything you just said. I want to take it one step further and say this actually does come to fruition. We actually do implement a bunch of wildly high tariffs. What's the best way to profit from this as a market participant? Like, we've seen uranium kind of pop off here recently. Is that something that interests you? Coal,
uranium's
steel?
already so uranium's already a thing that I think over the long term, if we can get the narrative right and we get the proper, so if you get the proper approvals for these small modular nuclear reactors, I think the uranium play is going to be a solid, 5 to 7 year play, right? And so I feel like there's going to be something there, and you can base other things off of that, right? So you're going to have copper as a part of that uranium play and the expansion of nuclear or small nuclear reactors. You're going to have the expansion of concrete. People aren't even talking about concrete, but concrete can actually be something that's in a shortage. We actually saw that during COVID-19 in some areas of the country. So you can look at like a Vulcan materials. So I think that's like a separate side. 100% tariff policy. What you would see from a brick standpoint probably would be the energy play would be one. If they go through, or he goes through with some of these tariffs that he wants to initiate on Mexico, we will see a significant rise in energy prices as a whole. People don't understand. You can pump as much oil out as you possibly can, but if you don't have a refining infrastructure in place in order to refine that and consume it in-house, then I can't really do much with it. And so what we do is we actually export our oil, and what Mexico does is actually export to us gasoline. It's like hey, we send you the oil, they refine the gasoline, and this goes into this cycle, especially when you're looking at the heavier crude products that are out there, because they actually have the infrastructure in place. That's why they were going to be that conduit when it came to Venezuela, because Venezuela has, for the most part, some heavy crude products that are out there, and Mexico has the infrastructure in place to be able to refine that with little to no effort when it comes to adding additional chemicals in order to get it to the right product that you want to have, right? So I would say the energy play, I would say I wouldn't play an energy company on that, because their input costs are going to be directly impacted, and what they probably will be in the crosshairs because of their import-export strategy, right? A lot of the Exxon, Chevrons, they might be in the crosshairs negatively. So I probably would look at a pure play there. And then I would say last one, and I would say is you fade grains hard. The BRICS also includes Brazil, right? It's going to probably see even, I think Argentina declined to join, but they were offered to. So that could be something that they're open to. But once again, we isolate those countries. They're going to basically have a pact of grain transports back and forth. Like the biggest risk that they're going to have is weather. And we're seeing that already. You don't even need to have BRICS to see this rapid transformation of exports going from China to going from Argentina and Brazil over to China. They completely accelerated that. So it would be like a fade of grains. Electronics could also be a spike. Pretty much anything that's like we import, which is like a whole boatload of stuff. There's ways to play it. On the commodity side, though, I would probably play silver rather than any gold play for the inflation side of it, because once again, consumer electronics go up, prices go up. Silver is a huge import or input for consumer electronics. It's like 95% of all electronics have silver in one way, shape, or form. So that would be like another way to be able to capitalize on it. Once again, I don't think this is going to actually happen. I would be very shocked if they were to pull this off. But you could see like maybe some some things that are on the some writings that are on the wall right now. Saudi Arabia kind of declined and actually now is not looking for U.S. defense products and U.S. defense guarantees. That was announced late last week, I want to say, completely under the radar. We've been working on that for a very long time, going back and forth. That's another stable partner within the Middle East that's now like, hey, maybe we don't need your defenses. Why is that like a big deal? If Saudi Arabia gets our defense guarantees and gets our equipment, that gives us power and leverage. If they go and source their equipment from other individuals, that does not give us leverage. So there's a lot of different pockets that are kind of playing out right now that I think is something that we have to be mindful of. And some people don't even like listening or hearing these type of things. They're just like, point me to a chart and let me play it, which is all cool and dandy. If that's what you want to do, it's what you want to do. But there's definitely has been some really good alpha over the last couple of weeks, looking at some of these setups here, and just be mind of the tape bombs. He ain't even in office yet. We're getting tape bombs every other day. So this is going to be stuff that you got to be able to manage risk and be a little bit more forward thinking when it comes to your positioning, especially on the commodity side.
And when you look at tariffs too, I think another thing people don't understand, they're like, yeah, we're going to put tariffs on China. Like what happened last time? China just put tariffs right back on us. I mean, this is also brings in inflation into play. Like nationalism is inflationary. If you think about it in the sense of, yeah, wages would go up. Sure. Wages sound good. Wages could go up. But that also means that we could have more inflation under the surface. And if we have more inflation under the surface and a dollar doesn't go as far, that also brings in some pressure into the market. So once again, for me, I'm just seeing everything underlying in the market right now is kind of pointing towards more inflation heading forward. At least inflation bottoming. I'm not ready to make a call on like, okay, we're going in the 70s again. We're going to have hyperinflation. I'm not ready to make that call just yet. But I am saying like, and like Kevin said earlier, I'm not the biggest fan of analog charts. But at the same time, it's a template to kind of look at. I saw somebody took this chart, Sam, it's kind of funny. They took this chart and they moved, and Grant made this at All Star Charts. They moved it all the way back, and then they started to use it as the first wave is right now. Like we didn't like 2020 never happened or anything, like so they're trying to show that like inflation is going to get so crazy and it's just getting started. And for me, it's hey, we did see a big wave of inflation. If we do see another wave, it's probably going to start up pretty soon. I would just be open to that. And I think a lot of the commodities, a lot of what's going on politically is kind of just pointing to it, not to mention the Fed. And that's the best what you can do when you look at something like this. It's not hey, I'm going to just go buy oil and energy stocks today and go sit on it for the next 3 years because an analog chart told me to. It's let's continue to have an open mind to this. Let's continue to just weigh out the pros and cons for more inflation or less inflation. Let's just go from there. And finally, let's end off with the Fed. We haven't talked about the Fed much today. And I think that's also always going to be one of the most important things as it comes to inflation or where the market's going. If we look at this chart of the 2-year yield and the Fed funds rate, and basically what this shows is the second the Fed started to lower rates, bond yields started to bounce. And now they're kind of moving the other way. I think in the last couple of days, I think we've seen a little bounce in bond prices, which means bond yields are going lower a little bit, but it's nothing significant just yet. So what do we think the bond market is saying here? Why is the bond market not really even not, I've seen this happen in the long end of the curve many times. In the short end of the curve, I haven't seen it happen much. So what are we thinking that the bond market's trying to say here? And what do we think about the Fed?
I mean, I think the bond market, look, the bond market is obviously trying to price in what the Fed's going to do for next year. If you kind of look back, though, take a longer term view on this, rates going up after the first rate cut is not out of the norm. Usually the market gets a little bit aggressive going into the first rate cut, right? And so now we're seeing a little bit of a backing off. The economic data has been okay. Maybe you got a little bit of fear about sticky inflation. I think the reinflation narrative is not bad. I think it just depends on where the inflation's coming from, right? So if we do see reflation actually taking place, and that's on the back of good economic data that's going out, and then also wages staying sticky and around 0.4% a month. You're looking at what 4.7, 4.8% annualized wage growth. Let's see, you have PCE sitting at 2.5%. Still not a bad environment. That could be something that's normalized, right? So I don't think it's saying like run for the hills yet. And in fact, if you kind of look at a 10-year chart and you put it on a weekly, 3-year weekly, you can still make the case that it's flagging, right? We don't actually have a defined direction yet. It just looks like it might be flagging. So that's kind of where I think we're at here. I'm of the mind that we get to around 3.5% Fed funds by this time next year. That would put the 2-year, let's say at 3.6, maybe 3.65%. Tack on another 1.2% on top of that, or 120 basis points. You're looking at 10 years sitting at around 4.8, 4.7, 4.8, maybe high yield at 5%. I think this is actually just normalization. I think this is just normalization, and this is actually going to be perfect. Like if the 10-year stays where it's at right now, and the 2-year normalizes like we think it should, and the curve normalizes, that's actually a really good environment. And the Fed can actually have a higher rate environment and still keep economic growth the way that it's at, and we don't traverse back to darn near 0% interest rate policy. I think that's a win. Once again, I'll go back to the ECB, and some of their members were like, we need to still keep negative interest rate policy on the table. We don't want to be like that, right? So I feel
we're
like
never going to be there. Yeah.
I would never say never.
I never want to say
never
never, but I think there's a lot of reasons structurally why the U.S. can't do it at the moment. Sadly, we only have 5 minutes left, but we could go into that maybe next time. Yeah. But I did a bunch of research on that, but I would love to talk with you about that. That'd be a fun one. Maybe we could do that next time. Sam, what are you thinking about this one? And we'll just kind of end there. I know Kevin's got a hard stop in a few. So what are you thinking, Sam?
Yeah, I agree with what you guys said. For me, like a DBC SPY ratio is really front and center for me. It's down here at the 2020 lows. I don't know if you can pull it up, Jason, but momentum.
Send me the chart, Sam.
Sure.
I'll pull it up. Yeah, because I want to look at that. I know you may have sent it before, but I also like that chart. That's a really good chart. And I think generally when we're looking at this, I do think I have a little different view than Kevin from normalization. I do think it's more of a inflation possibly ticking up, But once again, it's a toss up. You can't know anything 100%. My thought is 2 more rate cuts. That's probably it for me. But once again, the data is always moving. The data is always changing. We could be back. I could have a completely different view in a week. So I don't want to say that because predicting the Fed is a losing game. But coming
Can
in
I
here
ask
and
you
looking,
real quick? You're saying total for the whole cycle?
no, just for now. I think they're going to pause after 2 is my thought.
And that's what the CME Fed Watch is saying. You look at Polymarket, same story. I think that's consensus right now.
Yeah, I think I just think that because of the 2-year and where the Fed funds is, but once again, it's a hard game to predict what the Fed is exactly going to do here.
Yeah, I think we get to 350, which we're at what 450. So I think we got four more rate cuts between now and the end of next year, which would get you 3 rate cuts for 2025, and then this if they're going to do a maintenance cut in next week, then that kind of gets you there. And then once again, you kind of look at that curve then and say, all right, so you get to 3.5 low end base normalization, right? I feel
So
like
I think that's a good thing to just kind of
thing.
think through. Is just like between I'll be on 2, Kevin's got 4. You guys can start taking bets today.
Yeah, let's say 3 here, 3 for next year, so we don't confuse people.
3 for next year. I've got 2 from now till whenever the Fed starts to slow it down. So Sam, here's your chart.
Yeah.
No, go ahead.
No, I was gonna say I cut Sam off, so I apologize.
Oh. So here's your chart,
this is it for me though. Like if this ratio digs in at this former low, inflation's coming back, and it doesn't mean it's going to come back this quarter, next quarter, this year, next year. I don't know. It could just take a while, but I think this has potential to carve out a base like it did back in 2020 and 2021. And then, as you see, it broke out at the very beginning of 2022, right when stocks peaked and rolled over. At an index level, at least, like you saw a deterioration in months before the indexes peaked. So that's kind of my mental model right now.
Nice.
What's this ratio?
It's DBC SPY. You could look at a CRB SPY. It's basically just commodities versus stocks.
And it's mainly heavily energy weighted.
Right. And like if commodities are outperforming, I think the Fed is done cutting because inflation's coming back. Because I think that this is, like Jason pulled up the chart earlier, of the second wave of inflation coming, and all of my evidence continues to suggest that's going to happen.
Yeah.
The funny thing about this whole thing is that like none of the commodities are signaling any of that.
That's not true. Look at coffee hitting new highs. Look at
but coffee's not like a considered to be
all
like
the softs. Look at natural gas. Look at gold.
Yep.
Look at silver. Like
okay,
sure,
so
if you want to say, I agree with you completely on. I can't get behind this just yet because of the same thing you're probably getting at, which is oil and gasoline look like crap, and until those start to turn up, I completely agree with Kevin. It's like you can't do it just yet. Like it's not the move just yet.
Well, I mean, the coffee thing is structural, right? When I kind of look at it, and you might be right, I don't think coffee is included on.
No, they took it out.
Inflationary, yeah. So if we're like looking at the metrics, you're right. Softs are going to do what softs are going to do. OJ's been doing its thing for a very long time, right? But I kind of look at the grains as being the first input energy, maybe the second one, because the grains are really
Kevin, you're talking bearish about grains, and I tend to agree with you that.
Oh no, I was saying in the scenario. Hold on, let me clarify, because thank you for saying that. I'm saying if that policy were to go into effect, 100% tariffs on bricks, I would be bearish grains, because it would literally push all those members to just purchase from South America more. That's my bearish thought on it.
It's what's hard about the inflation thesis, like you said, which is I like the idea right now of tactically trading it as the signals come through. Continue to get long the things that you have signals for. You have signals for coffee, great. You have signals for Cocoa, great. But be very patient on things like grains, especially with what Kevin said. That's a very significant development. Be patient on gasoline. I do see that funds are and speculators are picking up gasoline like crazy right now. Same with the commercials. Like the numbers just continue to drive higher on both sides, which is pretty interesting. But it's because of exactly what you said before, refining.
Yeah. But I wanted to, because you cut me off there, and I want to make sure I'm not doubting your thesis. What I was going to say is that the traditional areas that I focus on for inflationary gauges outside of natural gas is its own kind of weird thing right now too, right? Like
That's a
it's
good point.
really hard to like say, oh man, like this is the run, even though that monthly chart that we talked about like a couple of weeks ago kind of signifies, yeah, this is actually a cycle low for natural gas. So I want to kind of hedge myself. Like if you look at a chart of it, you can say, yeah, but there's also a lot of like weather things that are going on right now.
And it's natural gas; it does whatever it wants.
But here's the thing. The inflation that we are seeing sticky, this is where I was going at with this, is all services related, no input costs, as far as input costs really going on up from the commodity side. That's the scary part about that whole scenario. Usually it's goods that lead services, right? The price of gasoline goes up, you demand more wages, your wages go up, vice versa, right? You have this domino effect. But right now it's like electronics, in some respects, apparel, transportation services, flights, medical care services, all the stuff that we don't like on the commodity side really see. And you can, I'll take softs out of it, right? Because I can also say, yeah, egg prices. I just saw an article yesterday. It was like egg prices are ripping to the upside. It's like egg prices move 30 to 40% on a month-over-month basis. Like sometimes it just is what it is, right?
Yeah.
But what I find very interesting about your take, and this is what I was trying to compliment you on, and then also say it's a very interesting development. If the inflation comes back and it's not goods related, and we have a reverse type of cycle taking place, that's going to be wild. Like that's going to be terrifying. Ridiculously wild. Exactly. That's the one that's like, huh, how do we manage that? Because you can see inflation over the horizon. It's easy. You can go back and look at time and see exactly what needs to actually happen. Utility prices move to the upside. That's direct impact, right? Gasoline prices move to the upside, direct impact. You usually have like some grain event that does occur, right? El Nino is like torching fields and crops are dying off like it's the Oregon Trail. It's easy to see that type of progression. But what we're seeing now in the stickiness of it, it's like people are still questioning, like, I don't understand why these prices are moving in the way that they are. I don't know why airline prices are going up, continuing to go up when capacity has increased by 6 to 8% for pretty much each one of these airline companies. That doesn't seem like it makes a lot of sense, but it's happening. Now you put on the back of that the price action of goods.
Jet fuel's moving down, all those things. I mean, you bring up a great point. That is like a solid way to think about this. So let's end it there. Want to say thanks, Kevin, for coming on. As always, we have a blast having Kevin on here. Sam, thank you for coming on. Make sure to follow Sam. Bringing some great charts as always, bringing some great research. Sam and I both do a bunch of stuff at the Gold Rush as well. And thanks, I'm Jason, and this is Commodity Report. We'll see you guys soon.